Good afternoon, this is Stewart Solaka with ChicagoStock Trading here at the studios of MrTopStep, and today we'll be taking a look at the S&P 500 and the Japanese yen. And we'll call this video the Ebola Swan. Ever since on Friday we broke through the triple bottom at 1920, major support, we turned 1930 into resistance where we double topped, and we took that range from 1906 up to 1930, which was from Friday, expanding it down into the close where we saw liquidation into the 80s. Monday saw a repeat of this where the market rejected Friday's lows at 1906 and fell to breach below the lows of the day, expanding the same trend or the same pattern that took place on Friday. We saw liquidation into the close down into the 1860s. On Tuesday, we saw the relief rally. Market rallied off of the 60s and retested the scene of decline where it fell on Monday, which was into the 91 level. This is where the market found resistance, and we came back to fill the gap from the previous day's close at 66, however holding a bottom here into the 60s. Overnight today we attempted to hold this low. We rallied into testing resistance off Tuesday's highs at 82, where buyers weren't able to reclaim Tuesday's highs, and that led the market to drift back lower. As we breached this triple bottom of 1866, this range was taken from Tuesday's highs down to 1866, expanding that down into 1830, which is what we saw today, and even seeing a little bit of a further push. So if we look at the intraday chart of what took place, we did get a major cash open lower, market closing 75 on Tuesday and opening into the 40s on today. We saw the early flush fall into the lower volatility window, which was at 1834. The first test of the vol window saw the market squeeze off of that 30 handles up to take out the upper volatility window and set up a bull trap above 52. When the market was unable to sustain above 52, we saw the market drift back to retest the session lows. Once we saw the buyers unable to hold the market above 1830, that's when the flush came, where we saw another 10 handle move down, falling into testing major support from 1950 based off of some 07 lows, where we fell down to lows of 1813 before seeing a V-shaped bottom and a recovery all the way back to taking out the daily highs. So if we look at one relationship that we've been looking at is the Japanese yen. The last video on October 2nd into Friday, October 3rd, we were looking at the Japanese yen where it had a new low and it reversed to take out its prior high. This set up an attempt to allow aggressive buyers an opportunity to defend this low and see if the market can turn higher to take out the neckline and expand higher. This we saw take place on Friday. The market closed down into 91, so it did give buyers some heat into the close, but the following week we saw the market recover to take out 92.60, confirming an inverted head and shoulders pattern and also allowing aggressive longs an opportunity to scale out. This eventually, even as the S&P we saw was bid throughout the short squeezes, the yen was stabilizing at this 92.60 level, so that gave an idea that the S&P was lying, or the rally was either we would see the yen retreats back and see the S&P continue, or the yen continue to squeeze and the S&P retreat. And that's what we've seen, is the yen complete this objective, taking that range of 92.60 down to 90.80, that low, gave us that upside target of 94.50, where it's meeting some major resistance right now. It's also completed a short-term objective. So going forward in the yen, pullbacks now into this old neckline of 92.60, which is old resistance, now offers new support for these lows to attempt to hold and for this to attempt to bottom out. Looking at just to show you what we were talking about on Friday, this is how I played it into Friday. We're talking about the aggressive buyers coming in. So it did give that opportunity on Friday to buy it down into the 91.30s. Once the market saw a retreat higher, it gave opportunity to scale out and reduce exposure, and then scale out again as it took out the neckline at 92.60, and eventually today to complete the objective into the 94.50 levels. So the objective is complete over 3 handles, but I scaled out one of the last 2 contracts here and leaving 1 contract with a tight stop just to see if the market can sustain this squeeze, because we are seeing a little bit of a violent reversal here. We pull back below that. We'll be looking at the 92.60 level. Going into the S&P 500 daily chart, This is what we've been talking about, is how we've seen this V-shaped reversal breach through 1970, squeeze out the shorts, and now it's looking for new buyers to come in and stabilize the market. The market failed to hold 1968, which is what led to a very volatile session. Now, if you remember, a few weeks ago, in the beginning of October, every time we saw the market fall down and retest major support at 1930, that was defended. We squeezed into 1980. We saw some very violent short squeezes. Every time we broke down, a violent squeeze back up. This was the way the market was shaking out the shorts before finally letting go. But eventually, the more times it hit against that 1930 level, finally it breached through the August low of 1890. Wasn't able to recover back above 1878. Now that the market broke below 1890, it's confirmed that this breakout in September and July was a failed breakout, and there wasn't new buyers able to stabilize that or able to come in and support those higher prices. So this has created this flush down. Yesterday we had an inside day where after breaching 1890, yesterday we rallied to test 1890, and we were able to push through that, and that gave way for today's flush. We flushed down into testing major support from the April lows down to 1804, and that gives an opportunity right now for the market to try to hold and to see if it can recover higher. Going forward, 1864, which is Monday and Tuesday's lows, act as new area of major resistance that the buyers have to recover to try to target today's highs up into the 81, 82 in the overnight session, which is what's going to be needed to squeeze out shorts and set up for a reversal. Continued weakness below 64 gives room to target 04, which is the April low, followed by a major support down to 1750 with sell stops below the year lows at 1732. You know, we've had this multi-year trend from 2013 to 14. Once we've broken this trend of higher lows, so now we're seeing this attempt to reverse the momentum. The upside, we have to say, has been very relentless against the shorts. Hasn't given any breather for the short side. So we can probably try to expect the same thing if we are in a true correction, that the downside should be just as relentless on the longs and continuing to press on. So that's what we should be looking forward, is those support resistance 64, stops above 81, downside look at the April low, and we want to take a look at if the market, we do get above 81, we'll be looking at the 1930 up into the 1950 level as major resistance. One analogy I was looking at is the Fed is coming to a close with their quantitative easing, and this is like the last call of the party. Buyers were trying to stay for further drinks above 1970. They're trying to go for the last call, but somebody walked in to the party with the sickness, which was the Ebola, and rather than waiting for the lights to turn off, they just hit the exits, and that's why we've seen this panic, this rush to the downside. So until next time, have a good day.